I'm Alex Niehenke. I'm with Scale Venture Partners. We're an active investor in, amongst other things, the insurance space. I have investments like Root Insurance, Keep Trucking. One of the things I'm going to ask everybody to do is a quick aside on their experience with insurance. I got in a car accident a couple of years ago, driving 50 miles an hour. A semi merged into me. That was all fine. I turned out fine, but when I went and did my insurance claim, they said it was my fault because I didn't honk my horn when the truck had merged into me. That's a semi-truck. That's me. I'll let the rest of the folks maybe move and left introduce themselves.
Sorry to hear about your.
I did end up getting my money, but it was a bizarre interaction.
Sorry to hear about your bad PNC claims experience, but I run a company called Covr Technologies. We're in life insurance. So if you're not happy with your claim, you probably don't care. But we
that was good.
Pretty good, right? Yeah. We've built a full stack digital life insurance platform for financial institutions. So 78% of the life insurance sold in the United States is sold by somebody who identifies themselves as a life insurance professional. 22% is sold by somebody who is not a life insurance professional. So we've built a full stack, multi-carrier digital experience for an advisor that's looking to sell insurance into their client base.
Great, and good morning, Wayne Peacock. I'm the president of USAA's Property and Casualty Group. We're a 96-year-old startup that serves military families, about 13 million members across our system today. And I guess I'll share one of my insurance stories that's really from one of our members. Had a chance to go see earthquake damage in Alaska back in December, which if you haven't seen it, it's kind of an interesting casualty that we don't get to see a lot in the US. We did a great job taking care of that member. They're also a USAA bank customer. They were able to get their money right in their account. 2 big dogs and a big turtle in an aquarium. So they needed to find rental space. No one would rent to them until they found another USAA member who was actually in Japan but had an empty house in Anchorage. And sight unseen, leased it to them, and they were able to move the rent money around between each of their USAA bank accounts. So just a great story of bringing the whole ecosystem together at USAA.
That's pretty cool. I'm Jamie Hale. I'm the founder and CEO of Ladder Life. We are focused on making the process of buying life insurance instant, simple, and smart. So we rebuilt the full tech stack to take a 16-step, 8-week process, and now we collapse that down into average about 6 minutes. So we offer policies from 100,000 to 8 million, which is the high end of the life insurance market. And one of my favorite customer stories is actually from Hugh, who's not really far from here. He went through the process of trying to buy life insurance the traditional way 2 or 3 times, and then basically never completed because the paramed didn't show up, or the agent spent more time trying to sell him an annuity than he could like life insurance. It was just a nightmare. Unfortunately, Hugh's friend's wife passed away. He woke up. They were looking at the Instagram feed, and his wife says, "Well, I'm just really glad you got that life insurance done." And Hugh goes, "Yeah." Heads into the bathroom, looking at the Instagram feed, applies, gets underwritten by Ladder, offered a policy, bound and issued. He did it in about 4.5 minutes, all on his phone. So for a $1 million policy.
For life insurance.
For life insurance. Yeah.
That's awesome.
Yeah, pretty cool.
My name's Akshay, Naheta. I'm a partner at Softbank Vision Fund. Looking forward to sharing my perspectives, our perspectives on this sector. We've made a few investments in this space. I actually don't have bad stories personally with respect to insurance, which is quite surprising because it's such an archaic industry. But my health insurance is pretty amazing because I submit all kinds of claims for all kinds of alternative therapies, and they get approved and paid right into my bank account right away. So Cigna does a pretty good job.
That's great. A recruiting pitch for SoftBank right there. So InsurTech, right? We've seen just a huge explosion. 250 deals last year, same the year before, $10 billion deployed. Pretty crazy, because if you go back 5 years, I mean, I remember going to, it just used to be the FinTech conference. There was no InsurTech conference. What's going on, guys? What's changed? Why is this category suddenly so hot? Why are we having this panel?
I think we're at the very early stages and beginnings of a lot of transformation that's going to take place in the sector. I think you have all these large insurance companies that have massive moats that are protected by regulators, the capital requirements, the licensing requirements. If you were to start a you decide to start a brand new auto insurance company in the US and you try to go and get a license in every state, it'll probably end up taking you 15 to 20 years before you get all the licenses you need to offer, auto insurance throughout the US. So what we have invested in different subsectors. We've invested in a direct to consumer insurance company such as Lemonade. We've invested in an online portal that provides insurance comparison website, basically in India called Policy Bazaar, which covers 25% of all life insurance policies sold in India and 10% of all retail health insurance policies sold in India. We've also focused on a few niche insurance companies such as Zhongan in China. And then we've been involved in a few interesting companies that are using automation, AI, robotic process automation, and AI to effectively act as service providers to the insurance companies, thereby increasing their productivity and efficiency. I personally am most excited about that opportunity because I think those companies are destined to grow tremendously. They have massive stickiness because insurance companies are dinosaurs in many ways, and once you get in, it takes 5 to 8 years to make the pitch and get in fully, and once you're embedded, you're never going to get out. It's like
so Wayne, that just sets me up. Are you guys a dinosaur?
Well, we're a 96-year young dinosaur. But, I think Akshay's got it right. The way I think about this, customer expectations are changing, technology is proliferating and creates opportunities for disruption, and to the point, it's a very archaic industry. So there's tons of opportunity to be able to add value in the cracks and the seams of these big old companies.
Yeah.
I think what I was just going to add, InsurTech is a single word. The cube for insurance innovation is gigantic. You think about the term insurance, and you have at least 3 major verticals: life insurance, which is life, long-term care, disability, annuities; health insurance; and then property and casualty.
Yep.
And then the chain is, again, gigantic. Distribution engagement, policy issuing, policy administration, and then there's domestic and international. So there's not a single answer to why InsurTech is only in the beginning of the journey. So there's a lot of work to do.
And
a lot of opportunity.
What did you see where you woke up and you're like, this is what I want to do for the rest of my career? Because that's kind of what you're doing, right? You started a company here.
Yeah, I mean, my career, I joke, if you've seen the movie Benjamin Button, my career has prematurely regressed from working for a large insurance company, which wanted to innovate, but couldn't for many reasons, and had to make a huge commitment. And now I'm running a mid-stage startup company, but the ability to do it and really do it and change something where Americans can get insured, where they're not insured today, that's the big opportunity in my space: life insurance, long-term care, and disability. Whether whoever's doing it, 60% of Americans are underinsured.
Yep.
So the old model is not getting the solutions to the client. So taking a piece of that opportunity and trying to make it happen is exciting.
Jamie, how about for you?
Yeah, well, I mean, I think part of the reason you're seeing the opportunity is that's what customers' expectations and demands are, right? Our customers don't call travel agents, they don't go into bank branches, right? They do everything digitally first. So we're just meeting our customers kind of where they're at. You don't call up your friend and say, who's your guy? You Google it. The reason I started Ladder was really a personal passion. My dad died when I was 11. We had a simple life insurance policy and did exactly what it was supposed to do. It kept us in our house or in our community during a super hard time. So we didn't have financial distress when we had emotional distress. If you think of GoFundMe's largest campaign is really around bereavement.
Wow.
Right? That's tragic. And that is really, I think, a challenge of the life insurance industry not staying really relevant. So, I would tell my friends about this when they were always trying to figure out their financial lives. And they always came back to me pretty upset when I told them they should buy life insurance. Not because they didn't realize they needed it, but because they had to go through the timeshare sales pitch of getting ground down and getting offered a lot of products they don't want. So we're just trying to really redeem it, make it simple, straightforward, and really meet customers where they're at.
Yep. And how about, both of you guys are in the life insurance market. There's some differences to your go-to-market. Maybe you guys can hash it out a little bit in front of 20 VCs in the audience right now. You guys are going direct to consumer?
We go direct to consumer, and since we rebuilt the stack of both application, underwriting, and administration, all digital, all instant, all real time, we expose those via APIs and we partner. So we get about half of our customers direct online, about half our customers through partnerships. Places like SoFi, where we replaced a very old incumbent, and we doubled conversion and doubled NPS. Places like Esurance, which offers auto but doesn't offer life. We can have a very relevant conversation with them there. But our customers are self-directed. There's a ton of customers who still, open up that are, 30 to 40 that still open up, brokerage accounts with Merrill Lynch because they want that guide. So I don't think there has to be an either or, but I think I'm really happy with our segment of the market.
Yeah, we approach part of that market, but our more substantial market is through financial advisors. Most financial advisors talk to customers about accumulating assets and decumulating assets, and they give lip service generally to protecting assets. So we've simplified the insurance journey. We offer multiple products where the insurance discussion is now integrated with the financial planning discussion. And the facts are pretty staggering. If you're unprotected in your retirement plan, you can live too long, you can die too soon, you can have long-term care needs which derail your financial plan. And the simple fact is for 3% of your assets or your income, you can eliminate 90% of that risk. And for some reason, financial advisors don't like to have those conversations. So if you take out the friction, you make it easy, you offer choice because they want to be objective, we believe we can really engage that part of the market.
Cool. Akshay, Wayne, actually, I'm sure you have this happen every week. A new InsurTech comes through my office. I'm sure you have the same. They're always like, "Oh, we have this new data source. We have something that USAA can't do." Wayne, what do you think about that? Actually, how do you evaluate that? Because it seems like we're in this big data revolution. That's one of the huge drivers in InsurTech.
Yeah, I think one of the things we've done is bring our actuaries and our decision scientists together so that internally we're working on all those advanced capabilities that could enhance our more traditional actuarial science. So we're still very traditional in how we're filing, but we're using very progressive techniques to kind of challenge what might be the normal way of pricing risk. But I think as we move forward, clearly some of the near field opportunities are what we see coming out of cars today of miles driven and behavior. Sensors are everywhere, so the ability to bring that data into the equation and then turn that either into pricing opportunity or value add opportunities we think is huge. And then I think more and more there's an emerging idea of non-traditional data of your social footprint at all that helps build a better picture of risk, which I think has possibilities and then maybe will be retarded a little bit as we look at some of the privacy challenges that are out there. But in combination, we're working on it internally, and then we're looking for every opportunity to invest in companies that can help us expand our reach.
What do you think?
I think traditional insurance companies have that's one thing that they're not short of is data. I think they do an amazing job in underwriting and from an actuarial science perspective. Even a Lemonade, even though it's direct to consumer, at the end of the day, at the back you have an insurance company that actually they offload the risk to. So I think traditional insurance companies do a great job. Where they actually miss the trick is that they don't have data on certain types of cohorts. Mm-hmm. For example, if you're an individual that does deliveries for DoorDash and you're 20 years old, a traditional insurance company does not want to insure you because you're just 20 years old and they just think that that's very high risk. And so there are new cohorts of employees that are coming into the workforce that insurance companies don't know and have never insured before, and they don't know how to get their head around it, and that creates opportunities. So I think from a niche perspective, there's a lot of niches out there where you can have interesting insurance propositions. But I think the best place to be is to be a friend to the traditional insurance company and to provide them with services which can basically create a really attractive long-term business.
Alex, I'm going to add a little bit of a different perspective on this.
Go ahead.
I actually do think the InsurTechs do, in a way, have a pretty strong data advantage because we have both a data availability and data scalability that, as an incumbent, it's really hard. A lot of people's policy administration system, billing, collections, doesn't really talk to their underwriting system, doesn't really talk to how they manage their agents. We on average are collecting well over 10,000 data points per customer. The average life company is doing that really around 20, right? So if you look at the scalability and the returns of data and being able to move that data across the different parts of that value chain of how you underwrite service, all the things that contribute to long-term value, I think there is a real advantage to be going there first. USAA is really unique. They're an engineering-driven organization. They've invested a huge amount, but if you look out in the life space, that is not, that's not usual.
Akshay, you were saying something about working with the incumbents there, which was interesting to me, right? Like there's this big debate in the investment community around picks and shovels versus the direct plays. Lemonade is a direct play. Anything from the Softbank perspective you're willing to share there?
I mean, look, we just think it's extremely hard to scale. We like businesses that can scale really quickly, and we think that if you're going to start a de novo insurance company, it's just going to be really hard to scale. So we invested in Lemonade, but then we've invested in a company called Cambridge Mobile Telematics, which...
Talk about that a little bit more.
Yeah, I led that investment. Basically, it took them 8 years. They are now deep into 35 insurance companies in 20 countries. It's a B2B model, but the way they charge the insurance companies is a SaaS model per policy holder per month. So, at the end of next year, by the end of next year, nearly all of State Farm's auto insurance policies will be using Cambridge Telematics.
Wow.
So I mean, it took 8 years to get there, but once they're in, they're not leaving for another 20 years, and that can be a really valuable business over time.
One of the great things that Cambridge is working on is how do you create value as well. So we've actually had some great partnerships with them around safe driving apps, right?
Yeah,
Nothing to do with insurance directly yet, but the ability to get information back in the hands of drivers to give them real-time feedback that helps them be safe, save lives, and at the end, I think, creates a lower risk for the industry as a whole. So it's a really progressive company.
Yeah.
Insurance is kind of a crazy business, right? Because you sell a product and you actually don't know the cost of sale when you're selling it, which I think it might be the only industry like that, which also means being wrong can be really expensive. I don't know, Wayne, how do you think about that? Jamie, maybe you have perspectives.
Sure.
Jump in on that.
Well, I'll come back to your data point, right? We've got a very robust process to look in the rearview mirror and try to figure out what's going to happen in the future. In a static environment, that's really good. In a very dynamic environment, that's very challenging. So a lot of what we're doing with our progressive analytics is outside of our state filing process, trying to vet our models of forecasting so that we can improve the ability to guess right as we play forward. And then I would just tell you that having a lot of liquidity and very little debt and a big balance sheet helps when you don't get it quite right.
So you guys have that, but that must be hard for...
It's very different. So for life insurance, disability, and long-term care, you don't get to re-rate your policy base.
Yep.
You sell it once, and it's committed. So as long as that customer pays their premiums, you're committed to the claim. In the casualty world or the health world, you can re-rate every year. You can drop a policyholder if they do something. But that's why traditionally the underwriting process for life, long-term care, and disability has been so onerous because you can't change your mind.
Yeah.
You've rated that person once.
Yep.
So the availability of data now in the underwriting process up front, to Jamie's point, allows us to issue policies with much more precision and way less friction, where we can issue you a rated policy within minutes. And that's going to change the customer experience, and we hope really gets Americans to do what they're supposed to do, which is to protect their family from that risk. So if we all can collectively do that, we change the narrative.
Jamie, are you sitting next to Akshay intentionally to solve those capital needs?
Exactly. Everyone wants to sit next to SoftBank. No, what's interesting is you think about the life insurance value chain, if you know it really well, actually this challenge has been going on for a long time. Insurers have for a long time been pooling risk amongst themselves and reinsurers. Reinsurers are the efficient balance sheet. If you think about us scaling from our first policy, we wrote a policy for $1 million and you collect $10 of premium, that's a fairly asymmetric potential payout, right? But what's nice is the reinsurance market allows you to quickly move that risk into the reinsurance market and benefit from their diversified balance sheet and benefit actually from their data sets. So it's not like I don't have really robust and longitudinal data. I actually have great longitudinal data that I can then append all types of really granular data with and move it out. So I actually think the reinsurers allow there to be a lot of innovation. But I think from a venture capitalist perspective, they haven't spent time in the reinsurance world and really understand exactly how bordereau reports work, how treaties work, all these nuances. It's hard because it's like a specialized securitization market.
Yeah, I mean, it's one of the things that I think about a lot is I think one of the huge advantages that the incumbents have is just the strength of their balance sheets, right? That's a lot of property and casualty companies run almost at a loss from what they underwrite, but the power of the balance sheet. Yeah.
Most auto companies run at underwriting loss.
Yeah.
But that's not the goal.
No.
Well, I mean, we've looked at the direct-to-consumer play pretty carefully for two reasons. One is that most of the premium that gets paid out, there are the brokers in the middle that take away 25, 30% of these premiums. Yep. And so if you can get rid of that, then automatically the insurance company naturally will become profitable, because if you look at their ratios, I mean, really, if you add that back, it is a profitable business. And late 2017, early 2018, we were very close to buying a very large reinsurance company, global reinsurer, and converting it into a direct-to-consumer play over time. And it's just really hard to do, because I was with one of the executives of one of the world's largest insurance companies just last week, and they have 700 people in the IT department, and they're still coding in COBOL and Fortran.
Yep.
It's so archaic. And I said, hey, why don't you rip all your systems out, fire all these people, take a one-time write-off. I said, what's the write-off going to be? He said, well, it'll be, exact number he gave me is $3 billion. I said, but how much are you going to save over 10 years? He said, oh, we'll save more than like $6 billion over 10 years. I said, why can't you explain that to your shareholders? They said, oh, it's really hard. We have pressures on quarterly numbers, and I don't think the shareholders will take it well. So that's the biggest problem with the traditional insurers, that they just can't get out of the way from their own good.
One other trend that I've seen a lot in insurance, which I've never seen in another vertical, is strategic investing, right? Because insurance companies by nature are asset managers. And so you're seeing these young startups. I mean, Mike, Jamie, you guys both have Allianz, for example, which is interesting. They sell life insurance. You sell life insurance.
They don't sell life insurance in the U.S.
All right, but they're in your cap table, right? Like, kind of fascinating.
Sure.
Earlier stage. I mean, you guys have that, but like earlier stage companies to be taking that capital. Talk about that dynamic a little bit.
So for us, sorry, go Mike.
So I think our observation about Allianz, and we've talked with USAA Ventures and New York Life Ventures, Mass Mutual Ventures, it's an incredibly smart way for insurance companies who struggle to change their traditional distribution to diversify. Yep. So I think the main reason they've taken interest in companies like the innovators is it's a very efficient way for them to diversify their risks. So without alienating their embedded distribution channel. So they've been a great partner.
Yeah, I mean, they've been a great partner. They know the cooking, which is really great. So it's great conversations, because they understand how hard what we've achieved really is to achieve. Our average policy size, the average income of our customer, we're north of where Northwestern Mutual is. Yep. And they assumed that direct distribution online would be very small policies with older, less healthy people, because that's traditionally been the simplified issue or the guaranteed issue market. So in a way, they've been fantastic partners. You got to be careful, because we're doing a lot that we think are really giving us competitive advantage, and we don't want to necessarily share that. But you can find a really good way to partner if you're really looking to solve a problem, which we are, which is get more Americans covered with life insurance. So there's a lot of ways to grow the pie here.
Perfect. Wayne, you got 15 seconds for this question, then we got to wrap up. Is USAA an InsurTech? Are you guys a bank? And what are the implications for everybody else on this panel?
Well, Alex, I would tell you we're both, right? And it actually feeds each other. We have tremendous financial strength because we're in the insurance business. We have great engagement with our insurance customers because we have a bank, and they're doing business on our app every single day to manage their money, which gets them back in front of the insurance company. So it's great synergy for us.
All right. Sounds like both of you guys will be launching a bank in the future, and Akshay will have to do some work with our portfolio. Thank you, everybody.
Thank you so much.